Hello, this is the chart profit video, 2 hours into the trading day, Friday 18th of July. This is from the pre-open. Today we're looking at the E-mini S&P. On the 10th of August I marked aggressive selling over here, the red at the bottom. That took us back to support at 24.3650, our 7-month point of control, and we did in fact find support here. We did not have a value area printed below that level, which would be an indication of weakness. We saw a sharp rally. That rally took us back to first level resistance at that point, which was at 24.74, which was touched here but not exceeded. We saw a pretty violent reaction from there following that rejected probe. So on Thursday we saw a much wider lower value area here with again aggressive selling marked at the bottom. The concern here is that important support at 24.3650 has been broken and we are printing below that level in a weaker price location. And if we look at the current half-hour chart here, 30-minute chart, you can see the probe up into 24.74 up here, and we are now printing below that important level in that weaker price location. If we see that on the pulse chart here, those imbalances from the profile are translated across here to the S&P 500 chart, so the red bar indicating that aggressive selling, and that's at a point where we have red here on the breadth, a daily breadth indication, which is negative or not supportive from the breadth, and we also have the price oscillator below zero and actually heading down. So this pulse chart does not look particularly healthy at the moment. Looking here at the spider chart, the current daily chart for the spider, 5-month support is at 243.30 here, and as you can see that support has been broken. We're currently printing just below that point. And big support on the Russell 2000 ETF IWM at 136 has also been broken. As you can see, it was support here, but we are now printing below that level. Another important chart and level is the UK's FTSE 100 chart, the level being the 12-month point of control at 73.46, which is here, and again at the end of this week you can see it's printing below that level. So all these charts currently indicating a weaker price location, which is a little cause for concern. Quick look at the sentiment indicators. This is my version of the RightX Ratio, which has very recently been above 14 again here a few days ago. Extremely high, indicating that just recently the retail investors relatively have an extreme amount of money invested in the bull funds compared to the bear funds, and as a sentiment indicator again that's a cause for concern. This point here, just above 15, back on 30th of June, the ratio reached its highest level that I have in the database, which I've been saying is often a warning for the market. You can also see here just a few days ago that if we look at the RightX bull fund assets that I follow in isolation at this point here, they reached their highest level year to date. At the same time, bear fund assets relatively low, let me qualify that, remain extremely low here, indicating very few bulls in this data. And if we look at the public poll from AAII, we know that 3 weeks ago the bulls percentage reached 35.5. It's a little lower than that now. But 3 weeks ago that was an 11-week high. At the same time, just 3 weeks ago, bears percent reached as low as 24.3, which was actually an 8-month low, again indicating just very few bears in the data. Same thing in the investors intelligence poll. Bears percent currently at 18.1%, but up from 16.2 just 3 weeks ago again, and that was the lowest since July 2015. So again, strong indication, very few bears, therefore quite possibly an overly optimistic anticipation indicated here. Look at US fund flow data as reported. Equity funds, including ETF outflows, 5.9 billion in the week to the 16th of August, and that was the 5th consecutive weekly net outflow. When the 4-week flow, which is the black line, gets down to these kind of levels indicated here, will often mark an exhaustion point where the market recovers after a sell-off, and that's the most useful indication for the indicator. Currently you could consider this neutral or possibly bearish. Let's return to the charts. This is the T-bond ETF TLT. We talked previously about this major support down here. We are now currently printing above the 8-month at 121.63, and in the longer term all of this price action above that point, unless that point of control actually migrates, this is all a strong price location for bonds right here. As I say, it's quite possible the 8-month or something similar could migrate, but currently in the longer term a consolidation above a point of control is not a negative indication. Looking at oil, this is the oil fund ETF USO. Importantly, if we look at the major point of control, which was previously 1144, certainly on the last video that I produced 2 weeks ago, that was the case. This price action in here has meant that the major has now migrated down to 1014, this level here, and we are currently printing below that new major, which is weak price location for oil here. From this important low over here we have something like a bell curve distribution going on here, because the point of control at 1014 is almost exactly in the middle of that range. Important thing is price below that level now is weak. We want to see certainly price printing back above 1014 before you would become remotely interested in the long side. I gave a few weeks ago quite a breakdown on the commitments data, and we had a very close look at gold, and we referenced back to GLD, the gold ETF, and this level here, which remains the major point of control at 119.84, and I said that the bullish scenario indicated by the commitments data would be confirmed if we could see price back above that level. And we can see that's now the case. In fact, price earlier today hit its highest level since November. There's room to correct here, but as long as the major remains at this level, this will be a strong price location for gold. We'll now look at the dollar, and we'll start with the dollar index. Just to review, at the time the 6-month point of control was up here at 101, and we saw price rejected at that level, and then we saw just a minor level of support here from the 2-year at 95.57, and then when we broke below that proven support there was kind of sharp sell-off lower. I mean, August is seasonally not too bad for the dollar. We've had a little bit of a rally, and we've seen a 3-month emerge at 93.41. As we move into September, that's not particularly, as far as the seasonal pattern goes, it's not particularly strong for the dollar. And we remain here in a weak price location as long as we're below that 2-year and it doesn't move. Next 3 charts will all confirm that bearish positioning longer term for the dollar, with the Euro FX chart here strongly above its major 113.29. So this little minor higher low pattern and consolidation here that we spoke about at the time. It's rallied strongly from here. One thing that doesn't particularly sit well with that bullish chart is the positioning of the commitments data, where we see the commercials in black here at an extreme bearish net position, the large speculators at an extreme bullish position, and also the small traders as well here in the legacy data. As I say, that doesn't sit particularly well with the sort of bullish scenario that we see here, but that commitments data has looked pretty bearish for this chart for a while, and yet we're still rallying here. So again, a lot of room for a correction, but as long as it stays above 113.29, this chart is in a strong position. Not bullish for the dollar longer term. Longer term, you see the same thing in the pound chart, the British pound, currently below its 5-month, which is at 129.36. So we're at a weak price location. We're on a multi-week low at the moment. The big support is down here, 15-month, 124.78. Again, lots of room to correct in here, and unless the pound can get itself back above that 5-month, or it migrates, it's in a short-term weak price location, longer-term strong from my view. With regard to major controlling prices, the Australian dollar looks pretty similar, with the major down here at spot 76. And we've seen that rally, so again plenty of room for a short-term correction, but as long as it holds above that level, This is a strong longer term position. Finally, we look at the dollar yen. Below its 2-year point of control, 111.30. That's the important level to me. So this chart in a weak price location. From this important low over here, the halfway point through here has supported 3 times. I said in the pre-open, if this natural support is broken and proven support is broken, we may see a quick sell-off, but currently dollar yen hanging onto that support. Okay, that concludes. Once again, I wish you a good weekend and thank you for watching.